Welcome to the September 30th, 2024 Advance Report for McGowanGroup clients, built by McGowanGroup Wealth Management. Here we go. Two big pieces of news this week. First big piece of news. Personal consumption expenditures index comes in at 2.2% over the last 12 months. Inflation back to near 2%, which happens to be the Fed's target. And we're going to get to the Fed and how to predict the likely change by the Fed at the next meeting. And I'll tell you about that one too. Then the Atlanta Fed comes out. The Atlanta Fed goes all over the nation every week and updates what current economic growth is. Not last quarter, which was 3%. Well, I had put the slide in here at 2.9%. That was last week's estimate for the current quarter. To tell you how good that is for U.S. economic growth, the 20-year average is 2.1%. The best year ever was after Ronald Reagan cut taxes and regulation. You had a 6% GDP for the whole year. But 2.1 average for 20 years, 2.9 is healthy. But wait, right before I did the YouTube, Atlanta Fed says, no, it's 3.1, even better than last quarter. Wow, what is that not? Well, it's not a recession. Okay, McGowanGroup Wealth Management. By the way, I'm Spencer McGowan, your financial weatherman and president, founder of McGowanGroup Asset Management. We are the team that cares, a team of 11, and we actually serve affluent families right here from the Crescent in Dallas, which is the capital of capital, and Dallas is the new capital of capital, according to even the Wall Street Journal. Wow, that was nice. All right, we update every quarter, right? Every quarter we update. And I want to give you what we said at the beginning of the year, right? And I'll have to do a mea culpa if I get something wrong or a prediction that doesn't come to fruition. We'll cover those too. Now, I said in that update, 2024, a year of new highs. I put a question mark in case I was wrong, but I also covered why. Federal Reserve tightening cycle 2022 corresponds to a big old bear market. Tech stocks lost a third of their value. Everybody moaning and crying about the recession because the Fed raised rates. 2023 was kind of sloshy but turned out good. And 2024, consistent new highs. And we said this at the beginning of the year. The Fed has already said they're going to come down 3% over the next 3 years on the Fed funds rate, take the pressure off, and the net present value of high cash flow assets is likely to rise. Boy, howdy, and it did. Now, AI mania, and I'm going to show you market year to date, but AI mania, is it mania, hype, or reality? And the answer is yes, yes, and yes. What you're seeing is very much like the early 90s. Now, early 90s, you had PCs come out, and then PC networks, and of course, internet adoption. You combine those for more productivity, right? Financial advisors used to have to post their books by hand, right? That was a nightmare. And you couldn't delegate it because that was the regulator's conclusion, right? So it was, in other words, that productivity increased with PC, data management. AI is like that on steroids. Now, the 1990s was a bull market that lasted as soon as the Fed finished raising rates in 94. You had productivity increases. You had a big increase, of course, in stocks and profits at the same time. And AI is starting to look a little bit like that. And we'll show you some of the impacts on profits. All right, energy infrastructure. Oil got smacked down this week below $68, but the companies are still cash flowing. They're trading at about 6 or 7 times cash flow, buying back stock, and the dividends are fine at that level. Natural gas demand, back to AI. Who's going to power all the new data centers? Utilities ramping up. Well, the easiest before you get to nuclear, and we've added some nuclear to the portfolio too, but in this case, if we look at who's going to benefit first, Natural gas is the most readily available, and it has to go through what? It doesn't go in a truck, it goes on a pipeline. And those pipelines are still at about 7 times cash flow, paying a nice big old fat dividend. And if you take a data center, put it at the end, fastest way to get them power is actually just to drop a natural gas powered plant there and put some solar in just in case. And that way, what you've got is more natural gas demand, not to mention liquid natural gas exportation. Global high yield. This is one of the categories, and I'm just going to cover a little bit before I get to the Dow. Global high yield, that's a basket of B-rated bonds. Right now, they're still paying about 9%. The Fed cut really helped. We've had a nice rally in price. If they get to a premium, we're going to harvest back to tactical safety. And we've got some other high-yielding candidates in the bond category that we're working into the portfolio. Here, Dow Jones Industrial Average, over the past year, up 19%. You can see every time there's a big sell-off, that was July, then you had the early August, and each time there's a big sell-off, well, what's happened, the psychology, investors get demoralized because they sold too soon, right? Like, man, I regret that, I'll just hold. So you have a psychology that says it's hard for sellers to be there, or hard for sellers to make that decision. But this is the best time to harvest things that are underperforming, overpriced, get your tactical safety up. That's what we're doing right now. All right, how could you have predicted the Fed cut? Will the Fed cut? It's all over the financial media. People get spun up about it. Oh, the Fed has to cut, or they're going to cut too much. And if they don't cut, there's going to be pandemonium and puppies kissing kitties and people running in circles, screaming and shouting. Well, actually, the Fed's already said we're coming down to 2.5% over the next 3 years. We told you that back in March, which is why you should subscribe. Either that or be a victim all your life. Now, here, how did we know the Fed was going to cut by 1/2? I actually said that in the recording before they did it. Well, the T-bills led it. See? They fell by 0.5% before the Fed cut, okay? Now, what is this telling us about the next meeting? They went from 4.85, they're 4.7 right now, went as low as 4.5%. Why would the T-bills be below the Fed target rate? Because the Fed is leaky. These guys all play golf together. The Fed members, I've never seen them outside wearing nothing but a suit. Hope they don't do that at golf. But anyway, 0.25% cut. Next meeting, November 7th. That is what the T-bill is predicting. That's the day after the election, so it wouldn't be political, right? They'll still be counting votes, but anyway, this tells you 0.25%. Look what happened here. Fed cuts, and the long rates went up. Why? They were way ahead of the Fed cut. This 10-year Treasury right here had gone from 5 down to 3.6. So if you said mortgage rates are going to come down, they already did. They went down 1.5% or so from the peak. Well, here, it wouldn't be unusual for this rate to come down and the long Treasury rates to come up a bit. That would be a more normal yield curve instead of this inverted thing that supposedly predicts a recession. Whoa, look at this. Now, S&P 500. I told you I'd update you on earnings. Last quarter, 11% over 2023. That's part of the reason for the rally. Obviously, if this headline number starts to go negative, you need to have a lot more tactical safety like we do in the managed accounts here at McGowanGroup Asset Management. But 14 out of 500 companies have reported for the current quarter. Most of them report October and into November. So this is an update worth watching. 14 out of 500, that's not even 3%. So it's not a really fair sample size. But look at this. So far, that's a 25% gain in profits over last year. It just happened to be 6 companies that made up that huge gain. So we'll watch it as it fills in. October earnings season is going to be very important. All right, rest of the updates. I said nuclear, utilities, pharmaceuticals, and selective artificial intelligence, which just means better computer programming, by the way. And we plan to continue to raise tactical safety at big rallies. We've got our targets picked out. And then when you get an unexpected implosion like early August, we put some of that capital to work. You want to predict the next recession? I got a calculation for you. $200,000 two-income family, all right? Back in 2016, they paid $39,000 in taxes. 2017, they paid less than $31,000 in taxes. I did the math. Now, that is an $8,500 decrease in the amount of tax paid. Those tax cuts expire at the end of 2025. What happens? You take a $200,000 earning family and you raise their taxes by $700 a month. What happens to the economy? You have a definition of a contraction. That's the most important debate for 2025 if you're worried about a recession, in our opinion. All right, now, election years. There's lots of rejoicing, lamentation. Well, harken back to 2012. Congress went hard left, Obama gets reelected, and everybody on the right thought, man, this is just a communist takeover, I need to sell everything. But earnings were going up, dividends were going up, and we said, keep calm, carry on. And that's kind of our approach to elections, but pop some popcorn and have some fun watching the show, and we'll update you right here on McGowanGroup YouTube. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.